by helping households build assets and strengthen their balance sheets. My name is Jeffrey Lubell. I'm Director of Housing and Community Initiatives at Abt Associates. And along with Thierry van Basteler, I'm co-director of Abt's Risk and Resilience Methods Center. This webinar is part of a series of webinars sponsored by Abt's Risk and Resilience Methods Center. And the webinars are focused on different ways of using a risk and resilience framework to improve outcomes for individuals, families, and communities. As we use the term, a risk and resilience framework involves three main approaches to managing risk: preventing risky things from happening, helping people to prepare for risky events to minimize the consequences, and developing an effective response system to address the consequences of risky events when they occur. This framework can be applied in many different ways to improve outcomes across a range of different subject areas, and really one of the animating themes of this webinar series and of our Method Center is just the opportunity for learning and cross-fertilization across these different subject areas, each of which are applying similar principles to reduce and mitigate risk in different areas. Today's webinar focuses on boosting households' financial resilience by helping them build assets and strengthen their balance sheets. The core hypothesis that we will explore is whether households are in a better position to manage financial shocks, such as the loss of a job or a major unexpected health expense, if they have more assets and healthier balance sheets. We're joined for this webinar by Ray Boshara, who is a senior advisor and director of the Center for Household Financial Stability at the Federal Reserve Bank of St. Louis. The center conducts research on family balance sheets and how they matter for strengthening families in the economy. Before joining the Fed in April 2011, Ray was vice president of the New America Foundation, a DC-based think tank. He has also worked for CFED, the United Nations in Rome, and the U.S. Congress. We're also joined by Hannah Thomas, a senior analyst at Abt Associates in our Housing and Communities practice within the Social and Economic Policy Division. Hannah, before coming to Abt last year, was a senior research associate at the Institute on Assets and Social Policy at Brandeis University. Her research focuses on the intersections of wealth, family, and community. She explores individual and family relationships to wealth, and is particularly interested in the ways that access to wealth, both community wealth and individual wealth, impacts social mobility and opportunity. So the way we're going to handle this webinar today, we're going to have very brief introductions from Ray and from Hannah, just giving us a brief sense of kind of what they're working on and what their research focuses on. And then we're going to have a Q&A where I'll be moderating a series of questions and answers with the panelists and then opening it up to you for further Q&As. So we'll very much looking forward, Ray and Hannah, to what you have to say and to our conversation. So here are the panelists, and there I am as a moderator, and we're going to turn now to Ray just to introduce himself.
Thank you, Jeff. I really appreciate the opportunity, and hello, everybody, and really appreciate your time and attention here, and really look forward to your questions and comments. The Center for Household Financial Stability was established here at the St. Louis Fed in May 2013 to address the status, the impact, and the future of family balance sheets. I came out of the asset building field, and for 20 years prior to joining the Fed, I was primarily working on helping families build savings and assets, and we didn't really worry very much about debt. But then the Great Recession came along, and we shifted our focus from asset building, narrowly focused, to the broader balance sheet. Three reasons for that shift. One was the role of debt in bringing down both families and the economy. Second was the continuing, to this day, impact of weak balance sheets on family financial success, as well as on national economic growth. You've all read about the struggling middle class. Weak balance sheets are a part of that. And the third reason we're studying balance sheets is because there are distinct social and economic outcomes associated with family wealth or family balance sheets that are not associated with income and education and things like that. Below is a quote from a recent op-ed I had in the Washington Post, which tries to summarize why wealth matters, and we're trying from a research perspective to say, you know, in what distinct ways does wealth matter. Let's see here. There we are. Some of our key findings so far at the center is that, first of all, that the Great Recession literally wiped out over 2 decades of wealth accumulation. People don't realize this, but if you adjust for inflation and population growth, you know, the numbers are really remarkable. We literally are back to where we were in 1989. And in our view, what's emerging is a new fault line, a new economic divide between winners, who we call thrivers, and losers, who we call strugglers. Winners are those who are more likely to be white or Asian, have an education, higher education, and tend to be middle-aged or older. By definition, strugglers are folks who are minority, who have less education and tend to be younger. And remarkably, there's been a massive shift wealth towards thrivers over the last generation. As a matter of fact, even though thrivers are 1/4 of the population, over the last 25 years, their share of the nation's wealth has gone from 45% to 67%. Our other key finding is to look at some of the trends impacting family balance sheets. This would include income and expense volatility. It's growing. Changes in family structure. 2 earners are increasingly necessary for wealth accumulation and mobility, but we have an enormous increase in the rise of single-parent households or single earners. And the third would be the debt overhang. And then finally, the implications and policy directions from our work include looking at demographic drivers of vulnerability, age, race, and education, not just income, to start as early in life as possible to build a healthy balance sheet, to strive towards balance sheet diversification, beginning with liquid savings, and to try to broaden the ownership of capital in the ways that we have democratized the ownership of access to credit. And I will say more about each of those later in the webinar. Thank you.
Great. Well, thanks, Ray, for that introduction to your work. We're now going to turn to Hannah, who's going to introduce us to her research.
Hello, everyone. So I'm Hannah Thomas, as I've been introduced. As a senior analyst, and I'm specializing in the area of asset building and home ownership. As Jeff mentioned, prior to coming to Abt, I worked with the Institute on Assets and Social Policy, and we were interested there in really trying to understand the relationship between assets or wealth and how low-income and vulnerable populations are able to build wealth. And the reason being that we were interested in this is because wealth matters, as Ray has sort of alluded to. When families face a situation where they're unable to find work or they have an income, their income stops into the household for some reason, wealth is what they can turn to maintain family well-being. So we can think of it as income is a bit like a stream or a river that flows through a farm. And then when the stream or the river stops running, the farmer can turn to a pond to keep water going to his crops and make sure that the farm remains viable. But there's one puzzling thing that we see when we begin to look at wealth and the distribution of wealth. And the slide that's up here shows what that puzzle is. We see a big difference in the wealth that's held between different groups. Again, Ray has alluded to this, but I want to focus here on this slide on a couple of, or 2 different groups. We have white families who start in 1984 with about $90,000 in wealth at the median, and then African American families begin in 1984 with about just under $6,000. So they already start with this large gap. We then follow over time what happens to those same families. And by 2009, we see that gap has grown almost 3 times to 236,000. At the Institute on Assets and Social Policy, next slide, we wanted to understand why or what was driving that change in wealth for the 2 groups. And so we set about a research project that tried to understand, firstly, what the key drivers of wealth accumulation were for families in general, and then how this might differ by race. We drew on 2 different data sources to do this. a longitudinal set of 140 interviews that we conducted with families in 1998 and then again in 2010. Half of the sample at the beginning was white and half was black, so that we could track the changes over time as families built or lost wealth. And then we made sure that all of those families had young children in preschool, because we wanted to really understand how this might have an impact on the next generation. And we also drew on a national data set called the Panel Study on Income Dynamics to compare the findings that we got from that interview study and make sure that they were somewhat representative and sort of get a sense of how they fit into the larger national picture. So next slide. So the key takeaway from the research that I want to just give you, and that I'll be talking probably a bit more about later on in the discussion, is that household wealth mobility and resilience is really a function of the context that the family finds itself in. So when we try to understand what's driving that gap, the gap and how families build wealth, it's these three things that we think were really important that emerged from the interviews. The first is the employment context that a family finds itself in. The second is the social network context that they find themselves in. And the third is the place context, or neighborhood, basically, that the family lives in. And so the study really points to the fact that the wealth and resilience of a family is structured by factors that are outside of the household, and in some cases beyond the control of household members. And critical to our understanding here is that the African American households, and I think this will hold true as well for particularly Hispanic or Latino families, they find themselves in contexts that are less resilient and less able to provide household wealth mobility. I'm going to give you a quick example of how this plays out in the employment context. So in the study, in the interviews that we did with families, we saw that families who worked for employers that offered things like good benefits like retirement accounts, health insurance, education credits, or severance pay, and that also had flexible workplaces and a consistent work history, those families were able to build wealth more often than families that didn't have that employment context. And we saw when we looked at the national data and as well in our interview data, we began to see that white workers were more often working in occupations with employment contexts that were supportive for resilience and wealth building. And so that helps us begin to understand what might be driving that big increase in the racial wealth gap that we saw on the first slide. So I hope this gives you a little bit of a taste of the kind of work that I've been doing over the last 15 years. And gives some framing for thinking about the questions that we're going to be talking to in a little bit.
Great. Well, thank you, Hannah. Reminds me we should probably come back at some point and talk a little bit about home ownership and to what extent home ownership may have played a difference too as well in the disparate growth of assets for African Americans and for whites. So both lots of interesting ideas in those presentations. I've really been struck in talking to both of you that while we initially set up this webinar to talk about the role that assets play in helping individuals and households to be more resilient to change, one of the things I've noticed is that you both are kind of offering a constructive critique of the idea that focusing just on boosting assets can really make a material difference in strengthening their resilience to weather short-term crises. So I thought before discussing that critique, though, it would be helpful really just to take a step back and to summarize the core concept that you're critiquing. So maybe we could start with you, Ray. Could you summarize the evidence underlying the basic proposition that individual asset building can strengthen the ability of individuals and households to weather short-term crises?
Sure. Rather than summarize a lot of the evidence, let me give you a paper that's often cited, which is a paper put out by the Urban Institute in 2009, which found that families that experience a negative event, like a health crisis that prevents work or generates large bills, death or loss of a caretaker, damage to a home or car, those families are significantly more likely to experience material hardship Now that's true for all families, but low and moderate income families are the ones most likely to face hardship as a result of those negative events. Specifically, they found that families with assets are 23 percentage points less likely to suffer from general deprivation than asset-poor families after experiencing a negative event. Now, if you control income, 9% of that is because of differences in income, which means that about 14 percentage points are related to asset holdings. So that's a pretty significant finding. And for others who would like to see more research around this, I encourage you to see a book by Lehrman and McKernan in 2008 called The Benefits and Consequences of Holding Assets, a book that was published by the Urban Institute. So that's the basic idea, that savings and assets really do reduce the impact of a negative event on a family's financial stability.
Yeah, well, thanks, Ray. And that's sort of what my understanding has been traditionally, and that it's really not necessarily a large amount of assets that can make a difference. Mm-hmm. It's a relatively small amount relative, let's say, to a lot of the spending that we have on various social programs. But so, what's the problem with that theory? Are there limits to that? Help me understand kind of where you're coming from.
Yeah, well, that's a great question. I mean, there's nothing wrong with the theory at all. In fact, it's actually correct. But the main problem is that it's incomplete. And the theory and a lot of this evidence and a lot of this research was done prior to the Great Recession. So accordingly, we and many others in the field have now broadened our conceptual framework to encompass the debt side of the balance sheet. And so we are now looking at the entire balance sheet. So for example, just focusing on going to college, which is what we did for many years, without considering the effects of student and credit card loans to secure that degree falls short, just as we painfully learned, securing a home without thinking about the debt level or type of mortgage also falls seriously short. And so this may seem obvious now, but we actually don't have a conceptual framework for understanding the effects of asset holding on a broad range of social and economic outcomes. Well, we do have that on the asset side, but we don't have it on the debt side. Jonathan Zinman of Dartmouth presented a paper a few weeks ago where he concluded that research on household debt has lagged behind its sister literatures on asset side of the balance sheet. And Richard Cordray at the CFPB has backed up that point. And one good example of full balance sheet research is a paper by Min Zhan and Michael Sheridan in 2011, which found that liquid and non-liquid assets are positively associated with later college completion. However, unsecured debt is negatively associated with college completion. So that's a great paper that's trying to look at the effects of both sides of the balance sheet on certain economic and social outcomes. And yet, surprisingly, the real economic story of the last decade is the rise of household debt and its persistence in holding back the stability and mobility of families and the performance of the U.S. economy. Some of you might know that household debt literally doubled between 2000 and 2007, and that the U.S. debt and GDP ratio has grown fourfold since World War II. The personal debt to income ratio rose to 122%, a historic high. Today it's just over 100%, but far short of the 80% that we were in 2001. And this is still having effects on the economic performance of our performance of our economy. Atif Mian and Amir Sufi found that 2 out of 3 job losses from the recession were due to household deleveraging, and in fact, that's a process that is still going on today.
Interesting, interesting. So I mean, it makes sense to me that you need to look at the whole picture, and obviously there's a lot of debt, particularly kind of short-term credit card debt that really can hold student debt that can kind of hold people back. So what can we do about it? I mean, how can we help improve families' balance sheets?
Sure. Well, the first thing we have to understand that in this rise of debt and all the negative effects it had on families and economy, the thing that I'm struck most by from our research is that the real tragedy is that the families that were least able to manage this debt, were were the ones who were most economically fragile. In other words, the most economically vulnerable families, the strugglers that I mentioned, minority families, younger families, less educated families, were more likely to assume more balance sheet risk, not to reduce it. And so I think anybody working on, managing risk and building resilience must address this sobering fact. How is it that these more vulnerable families who were more vulnerable to some kind of a downturn, either in housing prices or in the economy, and most likely to suffer a hardship as a result of that, assumed more in balance sheet risk? And I think this is certainly a financial education or a financial capability challenge, but it can't stop there. And so where we come out on this, at least from a balance sheet perspective, is that families really need to diversify their balance sheets. They cannot concentrate their risk in one asset. They can't have debts that are too high. They cannot afford to be without, reasonable levels of liquid savings. And so the policy ideas I have and the ideas for practice all revolve around this idea.
Okay. Do you want to just tick off a few of those ideas?
Sure. Let me just mention, though, very briefly that I think a lot of people think a diversified balance sheet is a little hard to attain. It's something you hear from a Wells Fargo advisor, but it's actually the right way to think about how families need to think about building up their balance sheet over the long term. And so even Janet Yellen recently talked about the importance of diversification. So, it's critical that we think about this term, even though it sounds very remote to the very families that we're talking about. The first thing I'd say is start early in life. If you can start building a healthy balance sheet from birth or when kids enter kindergarten, I think that's the best way. That's the best way to do it, because there's a lot of financial capability building that needs to be done as well. So proposals in states across the country, Nevada, Maine, Rhode Island, that starts accounts at birth or when entering kindergarten, I think have a lot of promise. For adults, I think liquid savings is the idea that has the most promise, because it cuts across the family balance sheet in terms of your ability to weather storms, pay down debt, access better banking services and loan products, and purchase durable cars and long-term assets. And of course, not enough families have those assets. Fewer than half have enough liquid assets to weather a financial storm. And it turns out to be the #1 savings priority for for most families in the most recent Fed data. And one study found that, by Myers and Jenks, found that the ability to borrow $500 in an emergency does as much to reduce hardship as tripling family income. It's really remarkable. So very briefly, some of the ideas that I think hold a lot of promise, and I'm happy to return to these in the Q&A, are first, to really embrace the administration's new MyRA product, which is a great starter savings product. You can start it with as little as $25. The principal is never at risk. You can always get your own money without penalties or taxes. And eventually it can roll over into a regular IRA, and employers can make contributions. It's a great place to start. The second is tax time, where refunds average over $2,400, and for many families it's even more. This is an important source of income. One study found that EITC refunds are often a third of a family's annual income. And there's something called the Refund to Savings Project, which is incorporating prompts into TurboTax through the Intuit product. The CFPB is organizing something similar with H&R Block. So I think the tax time is a second great moment. And then I'll just mention prize-linked savings, which many of you might have heard about. You enter a lottery to win a prize, but you forfeit the interest, but you get to keep the principal even if you don't win the lottery. Prepaid debit cards with savings buckets, savings bonds, automatic payroll deductions into savings accounts through employers, and then escrowing savings as part of a mortgage payment or a debt management plan, I think also hold a lot of promise. But of course we have to think about better short-term debt products as well, including some of the great work that credit unions are doing, and a company called Zest Finance, which is trying to reduce the cost of payday lending to more reasonable terms.
Wow. Well, a lot of great ideas there. Hopefully we'll be able to come back to some of them during the Q&A. I'd like to turn back to Hannah. And again, the kind of pose the same question to you. I mean, what are your concerns with the traditional focus on helping individuals to build assets?
Well, thanks, Jeff. I mean, I want to start by just saying that I think the assets field has really pushed us ahead a lot in how we think about welfare, poverty, and how families, or that group of strugglers that Ray talks about, how they're doing. In part because it's helped us to think beyond income, where for many years we were very focused on that income question without paying attention to the important role that wealth or assets might play. And Ray's really pointed out some of the real benefits that we see. I think the McKernan study from 2009 that talked to the reduction in material hardship was really, as Ray said, critical to illustrating the importance of holding even small amounts of assets. I think that the place where I see or I have concerns with the traditional focus has been on this on the focus that we've placed as a field on the household level. And the household's an important for us to look at, but in focusing only on the household, we tend to miss some important leverage points, ways of helping families to build assets and access more resilience. So some of the research that we did at the Institute on Assets, and there are others in the field like Sandy Darity, who have also been looking at this, have pushed us to think about how wealth flows among networks, along network lines, for example. So extended family members may end up providing help to that household, to the household that's in trouble, and helping them to negotiate a difficult life event. And again, the community, and I talked to the importance of context. So the community provides another important context in which a family or household is located. And if we're not looking at that context, we're missing important ways that families are able to build wealth, or ways that they actually end up losing wealth. And I would see that those are some of the important things that we need to look at beyond just the household level.
Right. So say a little more, if you could, about the role that family networks play in helping individuals respond to financial shocks, because that's I think a really interesting area of work, and the whole webs of wealth focus that you've had.
Yeah. So as we were talking to families, who in this study, who obviously lived through several recessions. They'd lived through the 2001 recession, and then they'd lived through the 2008 recession. We got sort of a real sense of how they were dealing with and coping with life events like unemployment or health shocks, where either they or a key family member had been unable to work. They'd also dealt with divorces. So we saw sort of a whole range of different life events that they'd gone through. And we could see in the data that there really was this important role for some families who had that wealthy extended family network. They were able to ask for help with, say, some childcare, which meant that they could get a new job, or they were able to get help with paying household bills, even paying the rent and bills when they didn't have their household budget wasn't quite adding up. We also saw help from some families in paying for college for the children, or helping keep them in a school that they were at that was giving them a good opportunity. So we really saw many different ways that extended family wealth was being used by that household in trouble to keep the household budget going. I give just one quick example of a woman who was homeless, who became homeless, but she had started off by living with her father, and it was only when her father died that she lost access to the house because her family members didn't approve of her gay status. And so you can see that the sort of family resource that was there, that her father was offering for her to stay in the house, was a critical critical resource that she was able to draw on in a time when she actually became unemployed at the exact same moment that her father died. So she would, if her father had stayed alive, she might have been able to manage that unemployment period without becoming homeless.
Right. You know, it's certainly interesting when, you know, I think about on my life, and I'm sure many of us can think about back on our lives about how we've drawn on our family networks for help at critical junctures, whether it's, you know, in terms of affording education or dealing with crises that might emerge or buying your first house. So what could be done, though, for people who don't have those kinds of networks, don't have webs of wealth? Are there things that the government or nonprofits could do to kind of make up for it?
Yeah, I mean, I think, yeah, I sort of think about it in a couple of different ways. There are existing policies that we have that do a good job, a reasonable job, I should say, of creating that alternative web of wealth, as it were. They're basically an insurance against when those events like unemployment happen. And you know, we're all familiar with those insurance structures. They're unemployment insurance, they're disability insurance, but they're not always they don't cover as many people as they could, and there are barriers to people being able to access them when they need them. So in terms of sort of one set of steps that could be taken, we could really try to provide greater access to those collective insurance mechanisms that we already have in place and that have been in place for a long time. And then there's the second set of thinking that we can be doing about ways that we can build access to community-level pooling of resources. And I'm saying this all in addition to thinking about the individual level resources and what Ray has been talking about, because obviously building as much access to individual assets as possible is very important. But we can build these community-level resources through different institutions. Nonprofits can be one way of going. State-level government, city governments can be other ways of going. One example that I think is quite a nice example here is from NACA. NACA is an organization based in Boston that serves families around the country that helps to finance home ownership for many low and moderate income families. And it provides, in addition to the financing that it provides an insurance pool so that when member home buyers have a problem, they get into a period of unemployment or they're sick, they can go through that community pool, insurance pool, and get some help, financial help, to help keep paying their mortgage. There are similar models in the private market, and I know there have been some problems with those in the past in the US. So we'd have to be careful about the design of them. But I think models like this, we can think about these as different ways to pool resources so that families can have resources to draw on if they don't have that web of wealth to reach out to.
Yeah, that makes sense to me. It actually ties in, I think, really well with a question that we've gotten already from someone on the webinar. And I do want to encourage folks to start putting their questions in. We'll be turning to them soon, but this question is really just right on point. Question's asking if we're familiar with research on strategies for very poor households to help them avoid homelessness when they suffer a financial crisis and can't pay the rent. And this really, I think, ties in both to the idea of individual wealth, right? Because if you have some individual wealth, then if you have this kind of crisis, you can avoid eviction and remain financially stable, which, you know, can be really important for the children and for the individuals, the adults in the household. But also, it sounds like there are things the government could do, right, through eviction prevention programs that might act as surrogates in the event that you don't have the individual wealth yourself to weather that crisis. You'll have the ability, let's say, as Ray said, to borrow $500 or, you know, to access a web of wealth, essentially sponsored by a nonprofit or the government. Ray or Hannah, either of you have any thoughts about this particular question?
I can jump in with a couple of thoughts that I have, and I mean, in terms of rent So in terms of family of existing programs that I know of that sort of help in that situation, there are certainly some community funds that private utility companies provide for such households who may be having trouble paying the utilities, and in fact in Minnesota there's a community foundation which provides a fund that families can apply to get help even with covering the rent. The other idea that I want to bring up, Jeff, is actually an idea you talk about in your paper around landlord insurance, and whether that could be flipped around to provide coverage for families who are having trouble paying the rent. And maybe, do you want to talk a little bit about that? Because I think that would be really a great example.
Yeah, no, it's a good idea. I recently released a paper through the Bipartisan Policy Center that focuses on strategies for trying to make better use of scarce financial resources. And one of the ideas really is to try to, exactly as the questioner asked, try to create a fund that uses a risk and resilience framework to help people be more resilient to crises that might lead to evictions. And during the discussion at the Bipartisan Policy Center, one of the ideas that came up really was looking at the insurance that landlords have right now for non-payment of rent that protects landlords, and saying, well, why are we just benefiting landlords? What if we took that insurance product and instead turned it around and had it actually be available to help when the resident themselves faces a crisis? So the idea is the resident might pay a small premium every month, and perhaps the landlord would no longer need insurance, so the landlord could also pay a premium, so you have essentially a shared mortgage insurance product, and that product would make money available in the event that there was a crisis that made it difficult for that family to continue to pay their rent. And perhaps that would be a loan that would get repaid, or depending on their income, that might be a grant. But the idea would be the landlord would be better off because they would get their rent, and the household would be better off because they'd be stable. So yeah, thanks for suggesting that. We have about 20 minutes, so I want to encourage people to start sending in your questions. But in the meantime, I'm going to turn to Ray, and Ray, you should feel free to chime in on that point, or perhaps you might want to respond more broadly to Hannah's suggestion that we place too much burden for responding to crises on the backs of individuals. Do we need more of a collective assumption of risk?
Yeah, absolutely. I couldn't agree more. We actually do individualize too much risk and don't share it broadly enough, especially when it comes to the loss of wealth. In fact, the very premise of social insurance, unemployment insurance, Social SSI, Social Security, the original welfare, was to pull the risk of individual or family income loss. But with assets, we don't do that. Somehow when you lose your wealth, it's your fault and you're on your own. There was, in fact, in the original TARP bailout bill, a $50 billion provision to bail out underwater homeowners, but political opposition killed it, and that, in fact, was one of the inspirations for the formation of the Tea Party. So in broad terms, I think that the next frontier in social policy is to figure out how to pull the risk of asset loss in ways similar to the ways we pull for the risk of income loss. And we don't really have a national policy on that yet, but I think there's great examples. You've cited some already. But you've heard a lot about the sharing economy, Uber, Airbnb, and all these places. People don't think of those as asset strategies, but the less money you spend on depreciating assets, such as cars, the more money you can save and invest in appreciating assets. I'm also intrigued by a proposal by Amir Sufi and Atif Mian, authors of House of Debt. They have a proposal for a shared responsibility mortgage, where lenders would agree to ease debts during a downturn. In exchange, lenders would get a percentage of gains from the eventual sale of a home. And then Heather McCullough and B.G. Wu published a pamphlet on shared ownership strategies, cooperative housing, community land trust, shared appreciating mortgages, employee stock ownership plans. And then the website of the Democracy Collaborative also has some great ideas on shared ownership and community wealth.
Interesting. Yeah, no, I think this whole idea of really sharing the gains and losses is one that's probably worth exploring more. You mentioned the shared equity, home ownership ideas, community land trusts, and limited equity cooperatives, and those sorts of things, where there's an opportunity essentially for the individual to build wealth, but also some of that wealth is through home price appreciation is shared, so that the community essentially retains an affordable asset. I'm reminded, though, in a completely different context of these arrangements, essentially where you buy a share in the output from a farm, right? Community-supported agriculture, and you get whatever. If they have a good year, you get a lot, and if they have a bad year, you get less. But basically, you're getting something out of the deal, but you're also sharing some of the risks of a bad season. So perhaps just more that we could be doing on the financial side to really think about this.
And Jeff, I mean, one of the examples I think of that I've looked a little bit at is at the Market Creek Plaza out in San Diego, where in combination with a local neighborhood foundation, there was a development by the community of this shopping plaza, and not only did they share in the development of it, but they actually got to invest in the shopping plaza itself. So the initial public offering for the shopping plaza could be as low as $50, so that people in the community could actually buy into and purchase a part of that shopping plaza. And what you see happen over time in this plaza and in the community is that people are getting money back from the successes of that shopping plaza. The profits flow back to the community members themselves. So you have a shared community wealth, and then you have that flowing back into the household wealth.
Right. No, that's very interesting. We have some questions starting to roll in, and one of them kind of comes back to the idea of how do we build structures that really help people build assets. And the question is, do we know of best practices to help people in subsidized housing build a positive balance sheet and ideally move into market rate housing? And in this connection, I do want to just mention this great program that's offered by HUD called the Family Self-Sufficiency Program, and it's been around for a long time, since 1990, and it has at its core the idea that as you pay, that basically your income in subsidized housing is dependent on your income. You pay 30% of your adjusted income for rent. So if your income goes up, you pay more in rent. And so what the concept of this program is that you receive essentially services to help you overcome barriers to increased earnings, and as your rent goes up, you pay more in rent. As your income goes up, you pay more in rent. But if you're in the Family Self-Sufficiency Program, that money gets put into an asset account that grows as your earnings grow. And if you become independent of TANF cash assistance and you achieve your other goals, you actually get access to those funds. So it's a way of building in to a government benefit program an asset building component that makes you hopefully get to the point where not only do you have some assets to help you sort of take that next step in life, but you also have higher earnings and need a subsidy less, which can free up money to help other people. So any other thoughts on sort of strategies through housing or subsidized housing or home ownership to help people build wealth?
I'd love to hear some more questions.
Okay. No, that's good. We've already talked, I guess, about shared equity home ownership and about the Family Self-Sufficiency Program, and there are some related ideas that are happening in the Moving to Work demonstration. So here's a question. Are there any lessons from the global financial inclusion microfinance agenda that may be relevant to the search for solutions in the U.S.?
Well, I think we've actually learned a lot from the folks around the world about how to do this. You know, here in the U.S., we started off with this idea that poor people need long-term assets first and foremost, and we backed into the idea of liquid and emergency savings. But the folks around the world in developing countries had figured that out a long time ago. I'm also intrigued with savings clubs or savings societies that are doing quite well around the world. Jeff Ash has a new book out about this very topic, and I think a real challenge will be to see if we can create these savings circles or these savings clubs, where it's more of a community putting in savings, than just individuals. I think there's a lot of promise there.
One of the questions I think really comes back, Hannah, to something. Well, both of you were talking about the whole kind of role of race here. The question is, when race comes up for discussion regarding financial security, there's often a lot of silence and not a lot of understanding of how to kind of address it and deal with it. How can minorities be better served if they are always relegated to the sidelines in ways that building assets or balancing your balance sheet is literally a dream for many?
Yeah, this is really sort of at the core of the question of what we were trying to understand in our study, and at the Institute on Assets and Social Policy. And Tom Shapiro, who heads up the Institute on Assets and Social Policy, has really been, he and Melvin Oliver have been sort of at the forefront of talking to the difference in asset holding by race. And I want to just throw out there, for those that aren't familiar, sort of one key statistic that I think really speaks to this and the vulnerability in terms of resilience or financial insecurity that families of color face. When we look at the median wealth of a white family and compare it to an African-American family, we see that for every dollar of wealth that a white family has, an African-American family holds 10 cents to that dollar. Now, that makes it really clear then that when we're talking about financial security, African-American families and families of color, particularly Latino and Native American families, are really in financially precarious situations. So as I mentioned at the beginning, in the study that we were doing, we were really trying to understand what was it that enabled families to move forward in terms of wealth building so that they could be in a situation where they weren't as financially insecure. And I think the things that I mentioned again at the beginning, that are these three important contexts, were the employment context, the neighborhood context, which relates to the housing context, and then the extended family wealth. We've talked somewhat about the extended family wealth, so I want to just speak to the employment and to the neighborhood context. We have an employment and a neighborhood system that's pretty segregated in this country. And so the challenge is in both of those situations where we have employment that tends to be more oriented towards white families in occupations that have strong benefit and wealth building structures, how can we desegregate and have a more financially inclusionary employment setting? I think part of this we have to look to policies around sort of the explicitly anti-discriminatory, and then we have to look at ways that we build education and investment in our workforce and build access to those jobs. And there are a host of different ways that we can be doing this. If we look I'll point to, because I don't want to go on forever here, but just point to a brief that the Institute put out on this topic around what it calls employment capital. There are some good recommendations, I think, in there. And then the second piece is around the neighborhood segregation question. It's gnarly. Neither of these are easy solutions. But the neighborhood and housing piece is particularly challenging because so much of wealth is held in home ownership. We're sort of talking in above 50% for many groups, and higher if you're a family of color. So how do we begin to address desegregating neighborhoods and giving greater access to neighborhoods that have stable and higher price home ownership? The study the interviews revealed really, I think, that access to those neighborhoods is going to be challenging. We can have policies in place that help provide that access. For example, shared equity home ownership provides a leg up for many families to get access to neighborhoods that have more stable and higher price housing. We can also look at improving the neighborhoods and improving the stability of the neighborhoods that are at the moment less well priced and less stable in terms of house prices. So there's a lot that we can be doing, but I think that the challenge is getting a unified agenda to move forward, I guess, desegregation
Right.
and fair access to housing.
A very quick clarifying question that's come up by one of the viewers. So was race a proxy for lower income? In other words, did you control for income?
Yeah, so it wasn't a proxy for income. We had two parts of the study, as I talked about, I think, at the beginning. But the first part was 140 interviews, and we explicitly we had the sample divided between African American and white families, and then we also had them divided based on income and based on occupation. We looked at those different categories to I guess, improve our understanding of what was going on. And then in the panel study on income dynamics piece of the study, when we run regressions and we look at the findings, we do control for income. And when we look at the wealth picture, if we control for income, we still see that, I'll give you, this is an amazing statistic to me, but when you look at income groups, so you look at high income, medium income, and low income by race, you see that high income African Americans hold less wealth than middle income whites. So we still see, even when we control for income in different ways, we still see these large wealth gaps, and we still see that these different contexts are very important.
Right.
Right, and our research found that African Americans generally have about 40% less income than whites, but the real key is that African Americans have fewer opportunities to convert that lower level of income into wealth, probably due to differing rates of access to home ownership, employer-sponsored retirement plans, and inheritances. Echoing very much the research that Hannah mentioned earlier.
So that brings me to a question about home ownership. I mean, it just seems to me, when I've looked at the data, essentially you look at the, particularly for minority households, low and moderate income minority renters have almost no assets, whereas the homeowners, while obviously lower than white homeowners, nevertheless have sizable amounts of assets. And so homeownership seems to be playing a really important role in wealth creation, but Hannah, you talked about the kind of the disparate role for whites and for minorities, premised in part on where households are buying, which is really important. But Ray, I've also heard you lately talk about home ownership and really express some concerns about kind of the use of home ownership or the over-reliance on home ownership to build wealth. You want to just talk a little bit about kind of your perspective on that?
Sure. I think the wiser view going forward is to view homeownership as a capstone event, something you lead up to, not where you start to build wealth. So we recommend sort of the development of a healthy balance sheet, liquid savings, low levels of debts, modest amounts of savings in college or retirement accounts before pursuing homeownership. You almost have to think about homeownership is like the decision to have kids. You really have to take a long-term view. You have to be ready for it. There's a lot of costs, but potentially very rewarding over the long term. So, and we should remember too that if your primary motivation is to make money, homeownership is not the way to do it. If you look at long-term returns from 1983 to 2007, financial assets and stocks returned 7.2%. Pensions returned about 4%, and real estate, residential real estate, about 1.6%. So it's
Ray,
really,
it was leveraged, wasn't well, it's leveraged, right? Because you're only putting down a small share of the overall cost.
Well, that is true, and that's a really important point, and the imputed rent is actually very important. But if your main purpose is to accumulate wealth, you're better off having a more diversified balance sheet with some investments in equities, ideally through college and retirement accounts.
Right.
So I think of real estate as being part of the mix, but not the anchor, especially after the lessons of the lessons from the recession. So it's just put it in context, see it as a capstone event. And in fact, what I really like, Jeff, is your idea of sustainable home ownership, not just home ownership itself. And I think that reflects kind of my ideas of thinking about it as an investment that you lead up to, not one that you start with.
Right, and I would add to that the key here is to not look at home ownership as an end, but rather kind of as a means to an end. And if what you're trying to do ultimately, in addition to giving people a really good place to live, is to help them build assets over time, then it's really important that that home ownership be a sustainable transaction. So that means ensuring that people can actually afford it and that the rates aren't going to jack up over time, as they were with some of these teaser mortgages and exploding ARMs that we saw in the last financial crisis. And it also means having the systems in place, and this gets back to some of the ideas, Hannah, that you were talking about, kind of a collective system for helping people weather crises that might threaten their tenancy. Because I think you're right, Ray, that certainly stocks are going to return more than real estate values, but one of the big ways that people build wealth through home ownership is through the forced savings of a 30-year fixed rate mortgage, right, or 15-year, whatever the fixed rate mortgage is. But if you foreclose, all of that, it gets stripped away essentially, because you get back so much less than you paid in. And so it's really, really important to help people get into a position where they can sustain home ownership and then have the right supports in place to help them sort of continue to pay down their mortgage and to get to the point where eventually they've paid off their mortgage and they've actually built sizable wealth.
Exactly.
So we have 2 minutes, and I just want to give each of you a chance to, if you have any final thoughts. Hannah?
I guess just one final thought is really we want just to mention the piece around home ownership that I think is really critical is we don't have very good alternative tenure options if you either rent or you own a home in most cities. And I think we have to look to additional tenure options that provide people with security of tenure and control over their living environment so that they don't lose their homes.
That's a great point. And I think some people think of shared equity home ownership as one of those alternative tenure options. Ray, any final thoughts?
Well, as we think about building wealth and resilience, I would remind folks that at least we've learned in the assets field, the institutions play an enormous role, what Hannah is calling context. Differences in wealth accumulation are so much explained by who has access to wealth-building institutions and who, has access to wealth-stripping institutions. In many ways, we expect individuals to behave to build wealth, but in fact, it's institutions that are doing most of the behaving, and people react to those institutions that they confront, whether it's an employer, a nonprofit, a payday lender, a tax return. And so I think the real challenge going forward is to have more pro-wealth building institutions in places where low-income, minority, and struggling and less educated families reside.
That's a great place to end on. I want to thank Ray and Hannah for participating in the webinar. It was really interesting to hear your thoughts and perspectives. We will be making a recording of this available for download. There's an email address for Hannah on your screen if you want to follow up with questions. And just wanted to give you a heads up, we have some additional webinars coming up, one on February 26th on mental health and well-being, and on April 21st focused on strengthening communities through risk avoidance, mitigation, and response. So thank you all for participating, and we'll look forward to seeing you on future webinars.
Thank you. Thank you very much.
Thank you.
And sorry we couldn't answer all the questions. Thank you.